Changes in group structure, step acquisition, control to control. In the previous lecture, we discussed the step acquisition where the parent moves from a position of no control but has some amount of shares to a controlling position. In this very episode, we are going to talk about when a parent already has control but purchases additional shares to increase its stake. So if an entity who already owns 60% of the equity shares of a subsidiary acquires a further 30% stake, the parent does not lose control because the interest has now moved from 60 to 90. Just moved from a lower to a higher controlling stake. Secondly, goodwill does not have to be recalculated. The existing goodwill is left as it is. So what will happen is that the transaction will be between the parent and the non-controlling interest because cash will reduce because they are purchasing extra shares. The non-controlling interest stake will also reduce. Okay. So what will happen is that we'll have to debit non-controlling interest. Non-controlling interest is recorded in the equity section of the consolidated statement of financial position, meaning it has a credit balance. To reduce it, you debit it with a proportion. Okay. We'll see it in the test of our understanding that we'll be working out very soon. Then we have to credit bank because money is going out for the extra shares to be acquired. Then there will be a difference. We'll have to debit reserves in the equity section of the consolidated statement of financial position. Okay. Let's test our understanding. So Antonio owns 75% of Bruno. Antonio purchases the remaining 25% of Bruno on 31st December 2019 for $100 million. The non-controlling interest has a carrying value of $75 million. So we are supposed to prepare the journal for this transaction. So when we come to the solution, we would have to debit non-controlling interest with the $75 million because its entire stake of the 25% has been purchased. Okay. Then we credit bank with $100 million. That is what Antonio had to part with to acquire the extra 25%. Then the difference, we would have to debit retained earnings, which is the $25 million. It arose subtracting the $75 million from the $100 million. Okay. Let's finally test our understanding. Amaka Limited acquired a further 10% to its existing 70% equity shares it holds in Foster Limited on 31st March 2021 for $10 million. Goodwill on acquisition on the 70% holding was $5 million. And net asset at the acquisition date was $35 million. Now we have to assume that the goodwill is full goodwill. We have to make the right entry to record Amaka's change in ownership. So for solution, we debit non-controlling interest with $4 million. It came about by striking a proportion of the net asset. So 10% on the net asset plus goodwill. Then we credit bank with $10 million, the amount that was paid to acquire the extra shares. Okay. Then debit retained earnings with the difference being $10 million less $4 million, giving us the $6 million. Okay.